Being a great founder does not mean you're a great investor. Venture is a game of outliers. Only a few companies are started every year that matter, and you either need to be invested in those companies or in the funds that are backing those companies. If you're not able to do that, you probably shouldn't be doing venture. Say you got a $40 million fund. You need to produce about $120 million in exit value in order to get a 3x.
Yep.
You can get there with a single $1 billion exit. Now contrast that with a $1 billion fund. You need to get $30 billion of exit value now. The math is different, and you have to know which game you're playing. And I think where people get into trouble is they don't know which game they're playing and they blur it. If you had invested all of your capital the year before the iPhone launched, you'd miss that. If you'd invested all of your capital right before this AI wave, you're going to miss that too. And I think the biggest lesson to learn from there is that you can't time venture.
NBER data shows that the best operator-led funds outperform, but the worst ones really underperform. How do you, as a picker of pickers, make sure that you're getting the top 1%?
So first off, I'll just say,
hey climbers, welcome back to Climb by VSE. I'm Jake Kapoor, General Partner of VSE Ventures, and your host on Climb. Today I'm joined by my friend Noah Lichtenstein, who is the Managing Partner of Crossover VC. It's a fund that has a very contrarian thesis. They back operator-led VC funds under 100 million, which they believe are going to outperform the mega VC funds that dominate venture today. Noah has backed 23 managers, as a result has access to over 1,000 companies in their portfolios. That means he has a lot of data on what good looks like in the changing landscape of venture today. If you're a founder, this episode is going to help you understand the incentives of the people that write you checks. If you're an LP or a family office, this is an episode you cannot afford to miss. Noah, thank you so much for joining me on the show.
thanks so much for having me. It's great to be here.
So we're talking right at the end of Q1 2026. I want to lay the landscape for our listeners. In Q1 2026, the top 5 VC funds raised more money than they did in the entirety of venture did in 2025. And while that's happening, 50% of that money is going to funds over 500 million, while emerging managers like myself are in a gully. 81% of the money that was going to emerging managers from 2021 has dropped off to 2026. So in this landscape that we are in today, who is this barbelling in venture good for, and what does it mean for the emerging manager landscape today?
Well, I think that is the question of the day, and there's no doubt that we are seeing a massive concentration of capital among the largest of the venture funds. So what does that mean for emerging managers? Well, I do think that there's the negative, that there's only so much capital out there being allocated, and with larger and larger funds being raised in rapid succession, it really is sucking a lot of the air out of the ecosystem. And you hear about the denominator effect a lot. So until we start seeing some of these large IPOs that we hope are coming down the pike here, I think what you're seeing is more and more of these mega allocators pumping as much money as they can into these mega cap venture funds. And on the other side, those who are writing smaller checks, a lot of the family offices, they aren't writing as big of checks. There isn't as much of a quantum of capital to be allocated. So a family office might allocate to a few different funds, but they don't have enough capital to support this entire ecosystem. And at the same time, as these multi-stage platform funds get larger, it now increases the capacity for them to allow new people to access them. So benchmark at 500 million, good luck accessing it. But if benchmark were to raise 5 billion tomorrow, there'd be net new LPs that would then have access. So I think, we're seeing a new type of LP, and as these funds get larger and larger, you're seeing both concentration of capital from the larger allocators, the sovereigns, et cetera, but also now you see people who haven't in the past been able to access them, making a bet on recognizable brand names.
Do you think if you're advising an LP or a family office on how to think about these two things, should they be thinking about them as two completely different asset classes with different return profiles? It's all still called venture capital. I do the same job as like Mark Andreessen, right? Like technically, how should family offices, LPs be thinking about the return profiles of these assets?
Yeah, I think they're fundamentally two very different products. And, it was so interesting. Jack Altman, who's one of our managers, also has a great podcast, and he had back-to-back Josh Koppelman one week and then Mark Andreessen the other, both just legendary investors. And they both have polar opposite perspectives on the market. And I think that in order to believe that a $5 billion fund can produce venture scale returns, you have to just believe that the size of the outcomes is so much bigger. Whereas there's a lot more ways to return a fund if it's much smaller. So if you just do the math, let's say you've got a $40 million fund. The median size of all the funds we invest in is about $40 million.
Mm-hmm.
So with a $40 million fund, let's hold constant the ownership percentage and hold constant the dilution and quality of picks. But just say you got a $40 million fund. You need to produce about $120 million in total exit value in order to get a 3x.
Yep.
If you own 10% at exit, you can get there with a $1 billion exit and maybe a $200 million exit on top of that. Now contrast that with a $1 billion fund and think about that. You need to get $30 billion of exit value now. And if you just think about the curve of exit outcomes, right? There's a lot of $100 to $500 million exits, a lot of $500 million to $1 billion. There's a few billion to $5 billion, fewer $10 billion. Very rare to see $30 billion exits.
Mm-hmm.
So when you're doing the math on a small fund, there's a lot more ways to get to that return than the long tail that is required to be hit with a bigger fund. So I think they're fundamentally different products.
Yep.
The math is different, and you have to know which game you're playing. And I think where people get into trouble is they don't know which game they're playing and they blur it.
The interesting thing you mentioned there is about exit value,
Yeah.
right? What we haven't talked about is entry value.
Yeah.
As we sit in 2026, and I say this as a seed manager who has now been investing, if not running a fund, but investing for 11 years. When I started at Techstars in 2015, a seed round was maybe 12 to 15 post money. You can't even do pre-seeds these days in some cases for that, right? And I'm seeing the median seed valuation out of YC is a 4 on 40,
Yeah.
right? How do you advise your managers as they think about entry prices in a market where you need to be bigger to play, or you can't lead these and now you're getting subscale ownership?
Across our portfolio of fund managers, we have exposure to about 750 companies. We ran an analysis of what the median post-money entry valuation was about 18 months ago, and that sat at around $20 million.
Okay.
Right now, we just reran that again, and it's jumped up to about $24 million. Anecdotally, speaking to our managers, hearing the exact same thing, right? We don't tell our managers what to do. Otherwise, we're picking the wrong managers. But it is something I think every emerging manager is struggling with, and I think it speaks to why the earlier you go in terms of managers you back as an LP. So you asked about family offices and allocators. I think increasingly this all comes down to what is that manager's right to win? What is their sort of differentiation? What's their unique access? Because if they are the first call of these founders, they have the best chance of getting capital in at the lowest valuation. But if you're waiting and to be brought in by somebody else and you're not the first one there and you don't have ball control, then you're more often than not going to be subject to the terms that others are putting down. And if a multi-stage platform fund is participating and throwing a call option there, then you're going to see a much higher valuation because, quite frankly, they don't care if the valuation is 40 million versus 30. It's just we're
Are all the managers you're backing ones with ball control where they are like Jack's fund? Before he got acquired by Benchmark, he was leading rounds, and I know a few of the other managers you have as well. Do they all have to be leading those rounds, or are you okay when a manager comes in? They don't.
It's a great question. We are LPs in 23 funds.
Yeah.
All funds that we invest in have the four kind of following criteria. One is they're small funds. They're investing at inception. They are generally funds 1 through 3, where there's better alignment between GPs, LPs, and founders. Some call them emerging managers. We call them next-gen managers. And the fourth one that I think is what we're known for is that we back founders and operators turned investors. And so we have to be able to draw a direct line between that operating experience and why they're the first call of those founders building in a key network. So kind of zooming out a little bit, venture is a game of outliers. Only a few companies are started every year that matter, and you either need to be invested in those companies or in the funds that are backing those companies in order to deliver good returns in venture. If you're not able to do that, you probably shouldn't be doing venture. So we think about mapping out what are those ecosystems. There's some of the ones that are static and well-known. It's right now the AI research labs, so Skylab over at Berkeley or what's coming out of MIT or Stanford, et cetera. It's some of the, we all know the mafias term. But what are the modern day mafias that have strong engineering culture that overlaps with an entrepreneurial spirit? So Stripe, Uber, things like that. Others are the incubators, but now you see the next incubators, not just YC, but what are the next ones? What's coming out of who are the magnets in the Teal Fellows? You've got Corey over there at Z Fellows. You've got the Hacker House community. So I think what's really important is when we are underwriting managers, we want to understand, are you a founder's first call? And are you tapped into those key networks of connectivity that we think really matter for producing those outlier founders? Portfolio construction is the second thing, right? And so most of our managers are writing checks in the 250K to 750K range. And we see that as a feature and not a bug. And the reason why is because you can either have ball control, write that first check, put down the term sheet. Everything's on safe notes now, so maybe you can put it down on a safe note, and then the next stacked safe can be higher when someone else comes in there. I mean, of course, your listeners probably know this, but the cap is the effective valuation on these safes.
Yeah.
So when you have ball control, you can write the lead check, bring someone else in. That's great. Or you can have ball control, someone else can lead, but you're able to win that sort of next chair, second chair. And having that flexibility only works if you're writing a check that's 250 to 750.
Yeah.
We do have a few managers that write $1 million plus checks and do lead. That takes a higher level of underwriting because now it's not just your ability to win, but you have to win at the expense of then beating others who are going for that slot.
You've talked about family offices missing the AI wave because they were maybe a little skittish on emerging managers, right? We've seen emerging manager allocation from LPs drop 80% in the last 4 years. A lot of folks that raised their fund when I did are now thinking about fund two, and they're going, man, where are all the LPs that were writing emerging managers? How do you think about LPs backing funds that sub 100 million category?
Well, I think one thing we saw is that a lot of LPs got burned in the 2021 kind of ZERP era bubble. And I think the biggest lesson to learn from there is that you can't time venture. If you go back and look at every vintage year from 2000 through 2024, I believe it's 6 vintage years produced 84, 86% of the returns. And it's logical, right? If you had invested all of your capital the year before the iPhone launched, you'd miss that. If you'd invested all of your capital right before this AI wave, you're going to miss that too. So you can't time the markets. And I think study after study just shows that the best way to get consistent returns from the asset class is to be consistently and in a diversified manner investing in the private tech sector. And so I think that I've talked to many family offices that are kind of kicking themselves because they went heavy in 21, they did all the SPVs, and then they felt like they got burned, so they sat out, and now they just missed it, and now they feel like they're playing catch up. So my advice to any allocator is always to have a diversified strategy to be consistently deploying through cycles. And that's the best way to get consistent returns and avoid the big downfalls. And you might hit a spike, but that's really not, I think, why you should be investing in the asset class. And so right now, I think what you're seeing is you've got a lot of family offices that are either got burned. You see a lot of folks who are already over allocated to the asset class and are waiting on some sort of distributions. And then you see these sort of brand name firms that, to our conversation earlier, I'm not sure they're really venture funds anymore. It doesn't mean that's good or bad. I think it's just a different product. And now that they have access, when you've scaled from a $500 million fund to a $5 billion fund, naturally there's a lot more access. And so I think there's a perception of brand value, real or otherwise, we'll find out in some cases. But I think you just, as an allocator, need to know what you're investing in.
Yeah.
But the most important thing is consistent, diversified approach. If that's kind of, if you want to invest effectively in the private technology sector.
And I think a lot of folks do, because as they look at where the value is created in these companies, I use Figma. I love the product. I don't love the stock, right? You see how much value is created for folks that came in the private sector. And then by the time this thing got out to IPO, the public markets like shit on it. The challenge that I find with a lot of LPs is the point you mentioned about liquidity. So many folks that we talk to, both the ones that are already LPs in our fund, but even other ones that we talk to and kind of warm up ahead of a next fundraise, they go, hey man, that's great. I have been in 4 funds of this manager. I haven't seen a dime back yet, right? It's really, really difficult for, I would say, I keep using family office because that's our LP base, but even endowments or fund to funds who can look at all different asset classes. and say, am I getting a return premium
Yeah.
for the liquidity risk?
Mm-hmm.
Do you think the math is just broken right now, or are we just in a weird market?
I think we're in a transitional phase. It might be a little bit of a hot take, but I think that the bulk of liquidity that we're going to see in the coming years is going to come from essentially the private market IPOs. And with so much capital concentrating in these larger funds, I actually see that as an opportunity as somebody who's investing in funds that are investing at inception.
Yeah.
So if you've got large firms, and whether they're growth VC, whether they're PE, whatever we want to call them, that are looking to get maximal ownership in certain concentrated positions at the late stage, well, we've got a sleeve of managers who have backed them since inception and can start selling down positions, and there's a hot market out there. I think secondaries are a great place to be right now. And I used to think of secondaries as this thing. It was kind of the cast-offs back in the day, right? And someone needs liquidity, and it's these deals. That's not the case anymore. And so I'm consistently having conversations with our managers about what is the strategy and how do we model out starting to sell down positions that if you entered at an $18 million valuation and now it's at a $5 billion, why don't you start selling down parts of that position? And I had that conversation twice in the last 2 weeks with managers. One who owns about 1.5% in a company that's closing a new round at $10 billion. And that manager is doing the math and said, you know what, I'm going to go ahead and sell a portion right now because they're closing this round that's 4x oversubscribed. So I think that's a brilliant strategy. And I think something I want to focus on more is how do we more systematically help our managers make those decisions? But this might be a hot take. We'll go back in a couple of years and see if I was right or wrong. But I think that the earlier you invest, so as an allocator, the earlier stage funds that you invest in counterintuitively might produce liquidity sooner because they don't have to wait for the public markets. If you're leading a Series A round and you're sitting on the board, you've got to wait until the IPO for it to happen. You can't start selling that position down. But if you put in $500K at a seed round and then 3 years later it's the Series C or the Series D, nobody's going to think twice about selling down part of that position. So I actually think the earlier you go, the better position you're in to manufacture liquidity and DPI for your LPs.
Now we're talking, Noah. This is the kind of shit I love. So that precludes a couple of things, right?
Sure.
One is there's an active secondary market, which means these things are fairly valued.
Yep.
And two is the structure by which people are investing in them makes sense.
Yeah.
Believe me, we see a ton of SPVs, not just directly to us, but also from our LPs who see it and they go, hey man, you seen the SpaceX thing? And it's a SPV of a SPV of a SPV. And I go, yeah, man, don't touch it, right? So what do you think has to change about the secondary market? Is it just more opportunities, or is it like, the way we standardize safe notes for early stage investing, we got to have just a standardized SPV so that, we're not dealing with these crazy structures. But that's the part that blows my mind, is that you're absolutely right. At a Series D as a $20 million fund, if I can return 1x DPI, man, you're in the top 1% of managers that can do that, and yet the structures by which we actually do it. Maybe these are two different problems, but does that exist today, or are we still trying to find that market?
I think you're seeing early movers. I can tell you that most of the multi-stage firms that have good relationships with, they're thinking about their secondary strategy.
Okay.
I think secondaries are becoming an increasingly important part of overall strategy. And if you just think about, if you believe that there's certain concentration of winners, right? If you believe that there's going to be certain companies that just become the clear winners and the outcomes are larger than they've ever been, then it's a fight for access. Look no further than, as you said, those 4-layer SPVs that may or may not be fraudulent to some of these companies. And that's why I think our strategy is so reliant on founder-led funds that are first call of founders.
Yeah.
Because I want them to have that direct relationship so that it gives them more optionality. And so we've seen that manifest in a couple ways. One is just first and foremost, access to the best founders and outperformance. Very proud of the funds that we're in. Secondly is access to co-invests. Again, being that first call, they're oftentimes knowing before a round is happening and we're sharing that information. And then third is the opportunity to do secondaries and get more creative. So I think the closer the investor is to those founders, the more optionality there is than those who are kind of completely detached and are trying to find ways in.
Yeah. You mentioned this thing about the operator-led funds a couple times. Obviously, that's very unique for your strategy. One of the interesting data points that I found is that while it can be questioned whether financial VCs or operator VCs do better. What is not in question is the variance of the band, right? So basically, to put it in simple parlance, NBER data shows that the best operator-led funds outperform, but the worst ones really underperform.
Yeah.
So you're now investing into a sub-asset class within emerging next-gen managers that has a lot higher variance. How do you, as a picker of pickers, make sure that you're getting the top 1%?
That's the key. So first off, I'll just say I think that there are great professional investors and there are great funds that are being led by them. Yeah. It's not what we do. I'm a big believer in focus and being known for something, and we really want to be focused on founder operator led. So being a great founder does not mean you're a great investor. So we have very rigorous underwriting. So first is, is your operating experience directly tied to your right to win and your reason for being a founder's first call? That's kind of first thing. So take someone like Imad Akhund, who is the founder of Mercury. He repeat founder, Y Combinator, made over 300 angel investments. He's an incredible investor, and he's a magnet for talent for many reasons. Just because he's a great founder of Mercury doesn't mean he's a great investor. So in our underwriting, we're looking at that track record. We haven't invested in a single fund where this operator has no investing experience.
Interesting.
So it's all operators who have an investing experience. The difference is that they are now putting structure around their investing. And that's the big difference here. So what we'll look at, give you some examples. We'll take your track record. And I think what we do is a unique underwriting. It's very different than if you're an endowment underwriting Fund 7 of name the big firm, right? Very standard. You've got the SOIs many years to look at. What we're doing is we're saying, okay, let's look at your angel investments, maybe your scout portfolio when you're writing checks for Sequoia or General Catalyst. Let's look at the SPVs you did. Let's look at all of that. And we bring it in and we have a data system internally where we'll review all of their investments. And then we're looking for things, yes, like performance, but you really have to double click on it and say, okay, what was your average check size? Now let's look at your best performers and how did that relate to your check size? Did you only have 25K in your best performers while you had 500K in your worst performers? You want to look for that. Look for the strength of the syndicate of investors. Look for who most commonly marked up your deals. And we have something called the crossover index, which is our proprietary data set of our 23 managers, looking at everything from graduation rates, time between rounds, entry valuations, all that data that we have. We pull that in, third-party data, everything. So we really want to have a holistic look at someone's track record. And that's just, what have you done now? How do we then get confidence that that is going to inform what we believe their future performance will be?
Well, that's my biggest question. Is a 25K check and a 250K check are very, very different.
So the number one reason why we pass on an otherwise great fund is because we cannot underwrite their ability to maintain quality while increasing check size.
Yeah.
So at the extreme, let's say you go from 25K angel checks and you're phenomenal to now you're going to try to write $1 million or $2 million, or let's call it 10% target ownership. Now I have to underwrite your ability not just to see and pick great deals, but are you now able to win against first round capital, against Sousa, against now General Catalyst, Andreessen, and every big firm?
Yeah, everybody's coming down to seed, yeah.
But if I can see that you have an incredible track record like Imad did, of writing meaningful checks, and you're going from that size to call it 250K, and then I can say, yep, I can do the math and see how it works. And when I'm doing my references and diligence, I can talk to founders and say, can you see them stepping up? Would you have given them that opportunity? And it's also a reason why we haven't followed on to some other great funds that we have backed, is because they've increased the size of their fund, they're evolving their ownership targets, and they may be phenomenal. We could be wrong, but it's a different fund, and so we have to re-underwrite at that point.
It's interesting that you have a portfolio of these operator-led managers,
Yep.
but whenever I hear about a founder that maybe we backed a couple of years ago, now they're like past Series B, Series C, and they're angel investing, and I'm going, is that just a lack of focus?
Yeah.
And like, do I need to re-underwrite how I feel about this manager based on their focus? How do you feel about that?
Well, it's a great point. I think one thing that's worth clarifying is that operator and founder led doesn't mean that they're still operating those companies.
Okay.
So we have 23 managers. Only 3 are currently operating while they're investing. So it's the operating experience is tied to their right to win. So if you take Andy Konwinski, Andy is the co-founder of both Databricks and Perplexity. He's not active at either of those companies. His right to win is that he comes out of Skylab at Berkeley, which is one of the best AI research labs. He teaches there. He spends all of his time there. And so when the next Databricks comes out of that lab, or Conviva, Anyscale, LM Arena, or I guess it's called Arena now.
Yeah, Arena, yeah.
That's the right to win. So, and if I can pull on that thread a little bit more, all of our managers that we've backed fit into one of three archetypes. One is angel adding structure. So these are great angel investors who are now putting that into a structured fund. We have to underwrite their ability to increase check size and match their portfolio construction. An example of this was Yuri Sokolov, who was a phenomenal angel investor. He spun up Wayfinder Ventures. He was seed investor now in Legora, in BrowserBase, in Allo Atomics, Decagon. Incredible. Second is what we call scouts going pro. So this is somebody who has an amazing track record writing checks on as a Sequoia Scout, General Catalyst, et cetera. We have to underwrite their ability to now win that same caliber of deals without the logo behind them. Then the third is the operating investor. And we have three of those, and we have to underwrite two things. One is the balance of their fiduciary duties to us and to their own shareholders. And the second is how does their operating experience in being actively operating give them an unfair advantage? So for example, we have one manager who is a C-suite executive at a very hot, $4 billion plus, tier one backed firm. They are the logo that every Y Combinator founder is trying to get their logo as a customer. So he has an unfair advantage in that he sits there, sees every startup pitching to his company, sees what the engineers are using, can ask the head of procurement, hey, which ones are we going to increase our spend in? Unfair advantage. By being in the flow, that is an unfair advantage. And everything about, if you've heard me sort of say one thing, it's all about the right to win. So having access to asymmetric information and then being in a position to have an unfair advantage, that is what we're looking for.
Yeah. You seem like a very data-driven firm and a data-driven person. You're also backing managers that are investing at a stage where there's not a lot of data, right? And I've heard you say like a lot of these new AI sourcing and diligence tools are kind of hype. So help me understand that a little bit. You're a data-driven person. There's all these new data tools out there, but you don't think they're actually helping?
No, so I want to distinguish between two things. I think my comments about AI from an investment perspective are more how they're marketed. And I see them marketed as this magic 8-ball that you shake up this data and all of a sudden it spits out, you should invest in this company. And that's that is the right to win, is this magic 8-ball. I think that is overhyped and not the case. Conversely, I think that having an AI strategy and implementing data systems into your investing are table stakes now. You need to have it. The question is, are those tools and your use of AI giving leverage to your existing right to win? So I think that's the distinction
What's an example of that in your portfolio? Like who's doing it well?
I mean, all of our managers are using AI in one way or another.
Yeah.
But I'll just explain how we use it.
Okay.
Use tools. So we have 23 managers on a look-through basis. We have exposure to roughly 800 companies or so right now. We'll have 1,000 at full deployment. We track 120 data points per company that our funds invest in. Some of those are common things like name of company, geography, date of investment. But we also track things that are unique data that we have. Those are, some of it's proprietary, but some of it is, do we have multiple managers who underwrote and invested in the same company? Manager sentiment. How has the manager sentiment changed about these companies over time? Our North Star for data systems is not, we have all of this, now spit out which ones we should try to double down on and invest in directly. My goal with our data systems from day one has been, how do we at any given time look at this database of 800 companies and say, right now, what are the 10% of companies that we should be focused on and positioning ourselves to try to win allocation and position ourselves to invest in?
Yeah.
And so we use heuristics like time since last round of funding, strength of syndicate, manager sentiment. All of those things are intended to put us in the best possible position to win. That's very different than saying we have this magic 8-ball that says, based on this data, we know that this is the right company. And so we've done look back analysis. We've gone back and said, which companies that have gone on to raise a Series A from a tier one firm did we flag internally in our systems? What did we get right? What did we get wrong? And our systems are the worst they're ever going to be right now, I hope. And it's something that is a focus for us is how do we have a right to win? How do we stay ahead? Each of our managers gets their own data portal, and we pull in information that is from the third parties, and we take subsets of that data. But we also have our crossover index, which is 23 peer managers, similar vintage, similar size, similar strategy. And our hope is that we can continue to invest in that. And over time, as you know, with data, the more data you have, the more it'll compound and the better it gets. So my whole focus is on building the foundation of a system that will compound and get better and better with time. And the hope is that over time, it'll help us get better and better at making decisions and having time-based advantages, information-based advantages.
Does the data help you with co-invest as well? I saw an announcement maybe a couple weeks ago. Yeah. You invested in Ligora, which two of your managers also did. You came in, I think, at the Series D.
Yep.
Right. So pretty far along in that company.
Yeah.
What gave you the confidence to come do that? As you know, you're a fund of funds backing managers, but now you're also doing a co-invest. How should other allocators think about co-invest and when the right time to come in is?
One of the lessons that we learned in the past, I'll start with, is that I think we were too valuation sensitive early on. I underestimated the size of the outcomes possible in the AI era, and I underestimated the speed. And if you look at all the data, if you look at the PC era to the web era to the cloud era to now to the AI era, you just see the hockey sticks getting shorter and shorter in terms of the number of employees, the time to 100 million in revenue. Yeah. Now, I think there's a question, the jury's still out on durability of revenue and
stickiness,
all that.
Yeah.
But I, for one, am very bullish on this new era. So Ligora is a great example. Two of our managers did the early rounds. They were flagged internally in our system by these managers as potential fund returners very early. I don't remember the date off the top of my head, but in our investment memo, we track and say, here's when Yuri Sagalov first said that he thinks he's going to be this fund returner. And then here's when Jack Altman said this. And then we track that kind of over time. And that puts us into the sort of the funnel of, okay, if it's flagged as a potential fund returner, let's spend some time over here. So I have this whole, in our memo, all these touch points and data points from when it was reinforced that this company was outperforming. Now, we had the opportunity to invest earlier, and Crossover invests both in funds, and then about 40% of our capital we directly invest in breakout companies.
Do they all have to be breakout companies from the managers themselves?
Yeah, that's the goal.
Okay.
And we made some mistakes early on by just, again, underestimating the size of some of these. And so when you ask about this co-investment, our LPs many times look at us to be the diversified early stage eyes and ears, but many of them then want to put additional capital to work in concentrated bets. Yeah. And they look to us to be able to use our access and our information to help them underwrite that. So we drafted a 27, 30 page memo, whatever it was, and used our first party data, the relationships with our managers. But ultimately that was done as a co-invest because Series D is outside of our core mandate. We missed on doing the Series A or B.
Yeah.
And so my goal is to how do we make sure that we don't miss that next time? And that's what I wake up thinking about all day is how do our systems ensure that we have the best chance to reduce the misses that we have when we have the opportunity. But right now I think that company is on a tear. It's a 2-horse race largely between Harvey and Ligora, and we did our first party diligence, and we were very happy with everything we saw about Ligora and support those founders.
Across these 23 operator VCs, what was the thing that surprised you the most when you looked at whether it's their check size, their allocation, the sectors? What did you think was going to happen that didn't happen, and what did you not expect that ended up happening?
The two things I didn't expect to have happen were that two of our best managers were going to crush it too much, and one was Yuri Sagalov at Wayfinder. He's just done so incredibly well that Hemant and General Catalyst made him an offer, couldn't refuse to go lead seed investing over there. And then Jack Altman, who's just phenomenal. The opportunity with Benchmark just came up, and so those two are things I didn't expect to have happen. And coincidentally, LPs will ask us, well, what if your best managers go off? And I said, well, look, I didn't know Yuri Sagalov from Adam when we first met him. It wasn't like this is some Rolodex I drew down from. We did our work. We found someone we thought was special. We underwrote him and made a bet on him. And thankfully he made a bet on us too. So that's what I didn't expect to have happen. The other thing that happened that I didn't expect was seeing the large multi-stage firms increasingly lean into fund-to-funds programs now and trying to figure out their early stage strategy. I think that the right to win has moved earlier and earlier, and the rise of the super angels kind of exploded more. And what I mean by that is, you look at someone like Elad Gil, who is, a one of one angel investor.
Yeah.
He's now got 3 billion, under management. And when you have that 3 billion, you're no longer doing an angel check and passing that along to another firm. You're now a direct competitor to the large multi-stage funds. And so I see the large multi-stage funds that we talk to trying to think through, how do we find these founders at inception? Is it a new flavor of scouts? Is it a fund-to-funds program? Is it, just being more active in the hacker house community? I think everyone's trying to figure out, but I think there's consensus that you need to be in early to be able to have the right or an advantage to put more money in later.
Should more emerging managers be going out to these larger funds and saying, hey, if I can get a venture fund to fund to back me, both from a brand signal of, hey, I have this great, LP who happens to be a large multi-stage fund, but also from just the availability of LP capital for emerging managers. Should more emerging managers be seeking that out? And would you advise more of these multi-billion-dollar funds to be having programs for emerging managers like me?
I think there's been a number of approaches. It's been going on for a number of years, and most of the big multi-stage firms have some flavor of this now.
Yeah.
If you invest in a fund, that investment, I think, is only 20% of the value. 80% of the value, at least, is your ability to get the information out of that fund and then to be able to put that to work for yourself. And I think it gets incredibly challenging if you are a multi-stage fund because there's signaling dynamics. I think one of the things that is central to everything we do has to be trust. We have to earn and re-earn the trust of our managers. If they know that as soon as the information they share with me then gets passed on to a big multi-stage firm, that ends right there. And I've heard this many times. And so we've seen, some multi-stage firms set up a fund-to-funds program. They tried it. It didn't really produce the results they wanted because the caliber of managers that we're working with, they're these incredible founders and operators. The last thing they want to do is sit down and just be milked for information.
Yeah.
And so I need to be thinking through the lens of what are the things I can do when I ask for time from our managers? What's the information, the tasks, the things that I can do to help them so that I can earn the right for them to share that information with me and know that I'm going to use it to their benefit. Fundraising is hard. And it's sometimes you can't, if you're an emerging manager and as we've talked about, the capital sources are drying up.
Yeah.
Find those partners, but I just think that you want to be clear-eyed and thoughtful about that.
Yeah. Well, you do some really interesting and unique things too with Crossover where you have these events, you bring this community together, you've got a great LP base of 45 athletes and entertainers, which is, I think, how you and I got connected on some panel back in Clubhouse. Tell me about that piece of Crossover. It's like it's maybe the more public side of it, maybe not understood why those things are so valuable.
It's funny. I have advisors who give me conflicting advice, so maybe you have better advice for me. But, we have this sleeve of about 45 pro athletes and entertainers who are LPs. It's a very small percent of our capital.
Sure.
And on the one hand, I've got advisors saying you need to talk more about that. It's an advantage. On the others, they're saying, you don't want to be viewed as like, an athlete fund or this and that. So to be very clear, we don't invest in consumer products. We don't invest in sports tech. We have nothing to do with what happens in sports. That said, I've just always believed that excellence inspires excellence. And even before I started Crossover, I used to host a dinner series at my house, and you try to get in amazing artists and winemakers and founders. And I think that when you are exceptional at something, you get inspired by others who are exceptional at something completely different. And so as kind of athletes started to make a lot more money and some of the big names in sports really started to be viewed as more than an athlete and as business people, and you see what Serena's done and LeBron and what Kobe had done, I think this new generation of athletes who, by the way, you're the 8th man on the Milwaukee Bucks and you might have made $120 million playing basketball.
Yeah.
There was just this opportunity. So I didn't necessarily seek it out other than we became this nice diversified way for these people who are exceptional at what they do to access the tech sector And at the same time, our founders and fund managers are inspired. They watch sports. They want to meet them too. So it's been interesting. We use it very strategically. So we host about 12 dinners a year, and those are in tech hubs around the country. The formula is somewhere fun, sexy, no salesy. It's like very much vetted who's there. The mix is typically about 4 founders or C-suite of billion-dollar tech companies, 3 or 4 pro athletes and entertainers, and then 6 or 7 of the seed stage companies that our managers have backed. And we'll go to our managers and say, hey, here's who's going to be at the table. Which of your founders will get value out of this? And I remember one where we had C-suite or founders at this dinner from OpenAI, Decagon. Decagon was still a seed company then, but Databricks, Instacart, 2 guys from the Warriors, 2 guys from the Memphis Grizzlies, a women's gold medal soccer player. And what it does is, 1, it's fun, but 2, it gave some of these early stage founders the opportunity to be seated next to C-suite decision makers. And so we do a lot of those, but we use it tactically.
Yeah.
Look, we had one startup, can't mention them yet, but vertical AI company that's gone, just crossed 15 million in ARR without raising a Series A. And so this is one that our systems flagged, our manager had been talking about. So we spent time trying to get to know him. And I asked the manager, asked the founder, what's one thing we can do to really help you move the needle now? And he said, we're trying to close this head of engineering. And that engineer happens to be a very big Warriors fan. Well, we had a couple LPs who played for the Warriors. So we took the founder and the candidate to a game, brought him down on the court, got to take some pictures, dribble around. And that helped us, 1, helped him close the candidate. 2, helped us earn that kind of $500K allocation. And again, sizing is everything. So if we were trying to write a $5 million check, that wouldn't have done it. But that ace up the sleeve does help. And we're just trying to think about how to do it.
I mean, look, I think you should talk about it more. And I'll tell you this, because of our brand and marketing angle, it's probably obvious I was going to say that. But the truth of it is, it's so hard to stand out, right? So hard to differentiate. Why does a manager pick you? Why does a company pick you? We help our founders think about this all the time, where I say, look, one of my favorite people who is just so great at being a champion for their industry, it's like Ryan Peterson at Flexport.
I love Ryan.
A ship is stuck somewhere on the planet, and Ryan is talking about it. He is such a champion for this industry, where whenever something happens, Straight to Hormuz, first person whose Twitter I went to was like, I wonder what Ryan's talking about. And obviously he's talking about it.
Yeah.
Attention really, really matters. And I say this to all my founders. I say, look, if you are in law enforcement or electrical contracting or whatever it is, you are a champion for some customer. That customer wants to see you as the lighthouse. When there's a problem in their industry, you should be talking about it, right?
To be more tactical, whatever I can be. And so I think it's finding that balance. And we're a small shop, right? So we don't do much of a presence. I've done very few podcasts, and I think maybe it's just because I haven't been invited. No, no, but
You're welcome back.
No, I love it. I haven't done a lot of them. And so, for us, I think it's just being tactical. We had a portfolio company that is a vertical AI company for healthcare that their clients, they're trying to build their brand and get in front of more clients. And their clients' employees are frontline healthcare workers. They get no love. They are, work hard, don't get a lot of advantages. And so called up one of our LPs who plays for the Charlotte Hornets and said, hey, can you host 30 of these frontline workers to come to a Hornets game and create a unique experience for them? And so we were able to, for this company, enable them to go to their customer and say, hey, we're bringing 30 of your frontline workers. We're going to bring them to the game, put them in a suite, take them down on the court, take photos, and create a lifelong experience. And I think those are things that are easy for us to do, but really do go a long way. And one, are just good thing to do, but 2, it's helping this company now build a brand in that ecosystem as somebody who's different than these legacy.
And it's a different approach than like Saquon and Ramp, right? Like that's marketing, and he's an investor, and it's great. We're in this weird frothy moment right now. IPO market still kind of shut. Private market getting all of the allocation. Allocators want late stage access. Forecast for me, 5 years from now, maybe Anthropic and OpenAI are public. Some of these, the dust has settled a little bit in this very frothy AI moment. What does that world look like for emerging managers and for venture capital?
I like to look at things in terms of macros. And if you just look at this trend line of the role of, if you just start at the top, the role of technology as a share of our economy just continues to grow. I think if you take technology and healthcare out of our economy, our GDP is actually shrinking.
Yeah.
And so I can't remember the stat, but I think it's like 3x GDP growth. Technology is growing at 3x faster than the rest of the economy. And then you see the shift from public markets to private markets, and you've got, this changes every day because every day, SpaceX or Anduril or Anthropic raise another round, but it's more than $6 trillion in value in the private markets here. And you've got, you can no longer get diversified exposure to the tech sector through the public markets. You've got insane concentration, more than 50% of the NASDAQ, and I don't know the stat day to day, but outside of the Magnificent Seven or they call it the Elite Eight, it's hard to get exposure. So I think that from a macro perspective, we're going to see technology continue to play an increasingly large role in the growth of our economy. More and more of the value creation from technology is going to be captured in the private markets. And I think that if I had to guess, you are going to see a flight from the mega cap venture funds toward the earlier stage, smaller, more concentrated funds, or those that are more specialized, I should say. Mm-hmm. And right now, I think it's incredibly hard because if you're an allocator, it's really hard to invest in venture unless you're on the ground, in Silicon Valley. Knowing how to underwrite all of these firms is incredibly challenging. And so I think what you're going to see is that allocators, and some are starting to do this, are going to just look at the numbers and say, this name brand right here may be great, but the illiquidity and risk that I'm taking on is not being providing the result of what I need to see in terms of returns. If you look at the adoption curve of AI right now, a lot of people use AI synonymously with foundational models. And I think if you look at the adoption curve, all the components, whether it's from energy or regulatory or vertical, all that stuff is going to move along the adoption curve at a different rate. And I think we're super early. And so some of the companies right now that we think are the clear winners, I think are going to end up in the ash pile. And some that we haven't thought of are going to still emerge. And so I think we're still incredibly early. And I just think with so much money moving into the private markets and with how quickly and how cost effectively, revenue per employee we're seeing, I just think the entire chessboard of the global economy has just been flipped upside down and it's up for grabs.
Yeah.
What's different is the incumbents this time are prepared and are playing a part, and they're going to, I think, continue to do well. But outside of that, I think that we are going to see some massive companies built, and the most value creation is going to be found early on. So I think we're going to continue to see small funds, emerging managers. There might be a culling of the herd in the meantime. But I do think that the mega funds will start to split out into being their own sort of thing, but different from the traditional venture capital.
And it brings us back to the conversation we had a few minutes ago, which is as these outcomes become larger and larger, if you're an emerging manager, you could take your winnings at a $10 billion outcome for a Harvey or 5.5 for Legora. You can't do that as a larger fund. And here's the other interesting piece of it, right? Now the existing AI players, the winners, let's just use legal as an example. The legal players are now bigger than the entire legal software market in the SaaS era. So if you think about, maybe both companies do IPO and they do IPO successfully, but acquisition and M&A is largely off the table unless you think it's going to be by a Mag 7 company. So that definitely changes the math, right? Because now if you're a big fund who is backing these companies, you are betting solely on an IPO. Yeah. There isn't really a buyer. Whereas for me, a fund of my size, 20 million, hey man, $11 billion outcome today. If I can exit to the secondaries, return money to my LPs, everybody wins. Yeah. And so it's a very interesting dynamic that we're in right now where the new AI players are eclipsing the generation that came before them.
I think that's well said. And I think that it's always hard to predict the future, obviously, and I think the speed of innovation is just incredible right now, and I think that the venture funds are going to continue to innovate. So I think that look, the folks who are building these mega platform funds aren't dumb, and they've built incredible empires, and they're going to continue to innovate. They're going to continue to find a way. And so I don't know what that looks like, but the way I sort of think about it is, look, we're riding this escalator right now that's going up and to the right of technology, continuing to be a more important share of our economy. I think the bulk of wealth creation from this is going to happen in the private markets, and it's going to be like a yo-yo on an escalator. You're going to have some go up, some go down. They're going to win and lose, but the macro is going to continue to go up and to the right. Yeah. And that's why, for myself, we believe the best strategy is a diversified, risk-adjusted way where we're getting this kind of best of the best beta through these managers who each have a right to win in the key networks that produce outlier talent. And then we're going to use that data and information asymmetry to increase the odds that we can make concentrated bets into the winners. And so I think our hope is that we can deliver great returns, regardless, but the alpha, if we get one of those right, is where we hope to build a great brand.
That's a fantastic place to leave it. No, I'm so glad you joined me, diving into all the stuff that I think emerging managers need to hear, need to think about. The right to win, I think, is the thing you brought up the most, but also access and being able to actually be early, be that first call. I can absolutely see why that makes your portfolio as successful as it has been. So thank you for joining me. And you got to do more podcasts, man. I don't know why you haven't. We got to have you back.
No, I love it. This is really fun. And congrats on everything you're building as well. And thanks for having me.
Thank you.